On September 15, 2008, Lehman Brothers filed for Chapter 11 bankruptcy in the Southern District of New York. The filing listed assets of $613 billion and debts of $613 billion. It was the largest bankruptcy in American history, larger than Enron, larger than WorldCom, larger than every previous corporate failure combined, by a considerable margin. The bankruptcy took approximately 45 minutes to file. The consequences took years to fully unfold. Within hours, global financial markets began to seize. The commercial paper market, the short-term funding mechanism on which thousands of ordinary businesses depended to meet payroll, began to freeze. Money market funds started reporting losses, triggering redemptions that threatened to become a run. Banks stopped lending to each other because nobody was certain which institution held toxic assets in what quantity. Within a week, the United States had effectively nationalized Fannie Mae and Freddie Mac, rescued AIG with an $85 billion emergency facility, and was constructing the $700 billion Troubled Asset Relief Program. Within a year, the global economy had experienced its deepest contraction since the Great Depression. 8 million Americans lost their jobs, millions lost their homes, retirement savings accumulated over decades evaporated in weeks. Lehman's collapse did not cause the financial crisis. The conditions had been building for years, but it was the moment when a crisis that had been contained became uncontainable. Understanding how that moment arrived requires going back to the system that produced Lehman as it existed in 2008. Lehman Brothers had survived, in various forms, for 158 years. It had survived the Civil War, the Panic of 1893, the crash of 1929, the Great Depression, long-term capital management, the dot-com crash, and September 11. Each survival became part of the firm's mythology, evidence of resilience, adaptability, fundamental durability. That mythology was about to be definitively disproven. Richard Fuld had been Lehman's CEO since 1994, and his tenure was, until the very end, one of the most celebrated on Wall Street. He had transformed a firm that nearly been absorbed by American Express into an independent powerhouse with global reach. Under Fuld's leadership, Lehman's profits had grown dramatically, and its position in the mortgage-backed securities markets, which would ultimately destroy it, had become dominant. Fuld was known as the Gorilla, a nickname that captured something real about his management style. He built a culture that prized risk-taking, celebrated the people who generated the greatest returns, and treated skepticism about the firm's trajectory with impatience bordering on contempt. He had also concentrated authority in ways that made delivering uncomfortable information to senior leadership structurally difficult, a dynamic that, when Lehman's real estate portfolio began to deteriorate, would prove fatal. The story of the 2008 financial crisis is, at one level, the story of a housing bubble. But housing bubbles had occurred before without producing systemic crises of comparable magnitude. What made 2008 different was the financial architecture built on top of the bubble, an architecture of leverage, complexity, and interconnection that transformed a sectoral correction into a global catastrophe. That architecture had been built deliberately over 2 decades with the active encouragement of regulators, policymakers, and academic economists. The intellectual foundation was the efficient markets hypothesis, the idea that financial markets priced risk accurately and that the diversification of risk through those markets produced genuine stability benefits. From this flowed a series of practical conclusions. If markets priced risk accurately, then regulatory constraints designed for an earlier, less sophisticated era were no longer necessary. The Glass-Steagall Act, separating commercial and investment banking since 1933, was effectively repealed in 1999. Capital requirements for investment banks were relaxed in 2004, allowing Wall Street firms to increase leverage dramatically. The derivatives market grew from a specialized corner of finance into a vast, largely unregulated system of side bets with notional values reaching hundreds of trillions of dollars. By the mid-2000s, a significant portion of the American mortgage market consisted of subprime loans made to borrowers with poor credit histories, inadequate incomes, or no documentation, often with terms that minimized initial payments while concealing the full cost that would emerge over time. What the industry called, with a cynicism the subsequent events vindicated completely, liar loans. The major credit rating agencies, Moody's, Standard & Poor's, and Fitch, occupied a peculiar and powerful position. Their ratings were embedded in the regulatory framework. Certain institutional investors could hold only investment-grade securities. The rating agencies determined whether a security could access the vast pools of institutional capital seeking investment-grade returns: pension funds, insurance companies, money market funds. The mortgage-backed securities Wall Street was producing in enormous volume needed investment-grade ratings to access this capital. The agencies provided those ratings in a process infected from the beginning by a conflict of interest whose severity is difficult to overstate. The agencies were paid by the issuers of the securities they rated, not by the investors who relied on those ratings. An agency that gave conservative ratings risked losing business to a competitor. The competitive pressure produced a systematic bias toward optimistic ratings. The specific analytical failure was in modeling correlated default risk. The models assumed defaults across the mortgage pool were largely independent. If that assumption held, diversification worked and the senior tranches of diversified pools could legitimately achieve very low default probability. The assumption was calibrated on historical data from a period in which American house prices had never declined nationally on a sustained basis. The possibility of a nationwide housing downturn was not incorporated into the models because it had not happened in the historical data from which those models were built. This is a textbook example of tail risk underestimation, the systematic underweighting of low probability, high severity outcomes, and it is a failure mode that sophisticated risk models are particularly susceptible to because they are built on historical data, and historical data by definition cannot capture outcomes that haven't occurred yet. The collateralized debt obligation (CDO) transformed the subprime crisis from a sectoral problem into a global systemic event. A CDO pools cash flows from a collection of securities and redistributes them into tranches with different levels of priority. The senior tranche receives payments first and suffers losses last. By creating this priority structure, a CDO could take a pool of subprime mortgage-backed securities and produce from them a new set of securities of which a large proportion were rated AAA. What was specific to Lehman was first its leverage. Lehman operated at a leverage ratio of approximately 30:1 at its peak. A 3% decline in asset values would eliminate equity entirely. A 3% decline is not a catastrophic crash, it is a modest correction. Lehman's real estate portfolio suffered declines far larger. The leverage was a deliberate strategic choice, enabled by the SEC's 2004 decision to relax capital requirements for the largest investment banks. That decision was a direct product of the belief that modern risk management tools had made regulatory constraints calibrated for an earlier era unnecessarily conservative. And when those tools proved incorrect, it left the major investment banks in the most precarious possible position. Lehman had also made a strategic decision to expand aggressively into commercial and residential real estate in the mid-2000s, acquiring several mortgage originators, including subprime lenders, precisely when subprime origination standards were most degraded. When the housing market turned, Lehman's positions became sources of large and persistent losses. Fuld believed, with what appears to have been sincere conviction, that the losses were temporary and recoverable, and that the market's assessment of the firm's condition was wrong. This belief was not irrational on its face, but it was coupled with an organizational culture that made delivering information inconsistent with that conviction extremely difficult. Mike Gelband, Lehman's global head of fixed income, had raised concerns about the firm's real estate exposure as early as 2006, that the positions were too large, the market dangerously frothy, the leverage catastrophic in the event of a correction. He was not heard sympathetically. He left the firm in 2007. The pattern, risk management concerns raised and not acted upon, information challenging the leadership's preferred narrative, managed rather than engaged with, is one we have encountered in multiple stories in this series. It is not a failure of the risk management function in isolation. It is a failure of the entire organizational system that determines what information reaches decision makers and in what form. Repo 105 was the most specific and technically distinct element of Lehman's story, illustrating the continuum between aggressive financial engineering and outright fraud with unsettling precision. In a standard repurchase agreement, a firm sells securities with an agreement to buy them back at a higher price after a short period. It is economically a secured loan and is recorded as a borrowing. Repo 105 was Lehman's variation. It sold securities at a discount of 5% or more, which, under a specific accounting interpretation that no American law firm would support, requiring a legal opinion from a firm in the United Kingdom, could be classified as a sale rather than a borrowing. This removed both the securities and the corresponding liability from Lehman's balance sheet. Lehman used Repo 105 transactions specifically around quarterly reporting dates. In the weeks before each quarter end, it would execute tens of billions of dollars in these transactions, temporarily making its leverage ratio appear significantly lower than it actually was. In the first quarter of 2008, the amount was approximately $49 billion. These numbers are not rounding errors. They represent a deliberate and systematic misrepresentation of Lehman's financial condition to investors, to counterparties, to regulators, and to the public. Internal emails described Repo 105 as window dressing. The bankruptcy examiner concluded there was sufficient evidence to support colorable claims of malpractice against Lehman's senior officers. No criminal charges were ultimately filed against Fuld, a decision that produced the same frustrated reaction that limited accountability in the Enron and Boeing stories had produced, and that raises again the systemic question about whether legal accountability for corporate fraud is adequately designed. While Lehman was allowed to fail, while Bear Stearns had been rescued 6 months earlier, and AIG was rescued the day after Lehman's bankruptcy, is one of the most contested and consequential questions in the history of financial policy. The AIG rescue the following day illustrates precisely why Lehman's failure was so catastrophic. AIG Financial Products had sold credit default swaps, essentially insurance against the default of specific securities, referencing hundreds of billions of dollars of mortgage-backed securities and CDOs. The firms on the other side of those swaps included virtually every major financial institution in the world. When AIG's positions lost value and it could not meet collateral calls, those firms faced the loss of their protection simultaneously. The Federal Reserve rescued AIG with $85 billion because the alternative was a cascade of simultaneous failures that would have made Lehman's bankruptcy look modest. Goldman Sachs received approximately $12.9 billion in collateral payments from AIG, funded through the government rescue. Other major financial institutions received comparable amounts. The taxpayers had rescued an insurance company so that it could make whole the Wall Street firms that had bought its protection. The human geography of the crisis is its moral center. The financial firms that had created the crisis were rescued. Their senior executives, in most cases, retained their personal wealth. The compensation Lehman's executives had received in the years of apparent success, bonuses paid on profits that turned out to be illusory, compensation for risk-taking whose true costs would be borne by others, was not recovered. Fuld received approximately $360 million between 2000 and 2007. This money was not clawed back. 8 million Americans lost their jobs. 4 million homes were foreclosed between 2008 and 2012. The neighborhoods where those foreclosures concentrated, predominantly in communities of color, in Sunbelt cities where subprime lending had been most aggressive, experienced economic devastation that persisted for years. Asset prices recovered relatively quickly, aided by the Federal Reserve's extraordinary monetary policy. The people who owned assets benefited. The people whose primary wealth was their labor did not. The Dodd-Frank Act, signed in July 2010, was the most substantial reform of financial regulation since the New Deal. Capital requirements for systemically important institutions are substantially higher today. Derivatives markets are more transparent. The most egregious forms of predatory mortgage origination have been constrained. New Resolution Authority provides a mechanism for winding down failing firms without the binary choice between bailout and disorderly bankruptcy. But the deeper reform challenge, addressing the systemic incentives that produced the crisis, was not fully met. Compensation structures that rewarded short-term risk-taking remained largely intact. The rating agency conflict of interest was acknowledged but not resolved. The intellectual framework of efficient markets was chastened but not replaced by a more adequate alternative. The Department of Justice did not bring a single criminal case against a senior executive of a major financial institution for conduct relating to the 2008 financial crisis. This was not the product of insufficient evidence of wrongdoing. It was the product of legal and prosecutorial judgments about the difficulty of proving criminal intent in complex financial transactions and the institutional culture of financial prosecution that had eroded during the preceding decade. Phil Angelidis, who chaired the Financial Crisis Inquiry Commission, said the financial crisis was not a natural disaster. It was a man-made disaster, the result of human action and inaction. He was right, and the absence of accountability for those human actions, the fact that the architects of a system that destroyed trillions of dollars of wealth and millions of livelihoods faced no personal criminal consequences, is a failure of justice whose significance extends well beyond the specific cases. It sends a signal. In American financial markets, there is a class of decisions whose potential rewards flow to individuals and whose potential costs flow to society. That signal shapes behavior. It shapes the incentives of the next generation of executives making the next generation of risk decisions. The 2008 financial crisis was, at its deepest level, a crisis of accountability. The people who originated the mortgages were not accountable for whether those mortgages were repaid. They had sold the risk. The investment banks that packaged the mortgages into securities were not accountable for the performance of those securities. They had sold them. The rating agencies were paid by the issuers rather than the investors. Their financial interest aligned with generous ratings rather than accurate ones. The regulators had been convinced that the system was managing its own risk adequately. The executives who made the risk decisions were compensated on the upside and bore no personal downside when those decisions proved catastrophically wrong. At every level, the feedback loop between action and consequence had been severed. The people who made the decisions were insulated from the outcomes. The people who bore the outcomes had no influence over the decisions. This is, in its essentials, the same structure that produced Volkswagen's emissions fraud, Boeing's certification failures, Enron's financial engineering. The specific mechanisms differ. The underlying architecture is identical. The Lehman Brothers bankruptcy was not an ending, it was a demonstration, the most powerful and costly in living memory, of what happens when the mechanisms that are supposed to keep the connection between action and consequence intact have been allowed to fail, one small accommodation at a time, until the gap between those who take the risks and those who bear the costs becomes wide enough to swallow an economy. They are the reason this story matters, not the leverage ratios and the CDO tranches and the repo agreements. The families who lost their homes, the workers who lost their jobs, the retirees who lost their savings. They are the human content of a financial abstraction, and their losses are the measure of what it costs when the systems we build to allocate capital stop serving the economy and start serving themselves. That cost is the lesson, and the obligation it creates to build better systems, to maintain genuine accountability, to refuse the intellectual comfort of frameworks that tell you the system is self-correcting when the evidence suggests otherwise, is one that each generation inherits from the failures of the last.